Hi guys, welcome to my channel KP Financial and Strategy Review. Myself Praveen Kumar. In today's video, we'll discuss about cash flow statement. We'll discuss in short summary what do you mean by the statement, how to prepare, and why it is important, and how it is different from other financial statements like P&L, balance sheet, other comprehensive income, statement of changes in shareholders' equity, how it is different from other statements, and why it is important, and which statement is more important than anything else. We'll discuss in short summary. In addition to that, I will also discuss about real life corporate scenarios, how they will prepare, how they will review, and how they will analyze, and what are the possible ways to manipulate and do fraud while preparing this, presenting this cash flow statement. We'll discuss in a short summary with real life corporate examples. And coming back to topic, cash flow statement. The name of the statement is cash flow, and it shows that there is one statement. In this statement, we will show the flow of cash. So what is at the beginning of the period, and what is at the end of the accounting period. So for this purpose, we'll take one accounting period. So what is on January 1st, what's in 31st December of the accounting period. So during this 12 months period, how much of cash is received, how much of cash is spent, from where it is received, and to whom where it is spent. Generally, this is what the cash flow statement means. But this is very simple and easy to understand. Anyone can understand this. But in real life, whether the cash flow statement will show in this much simple manner, reality, no. Cash flow statement will not prepared in this simple manner. It will be prepared. Cash flow statement will be prepared as per the respective accounting standards and regulatory compliances, and as per which this is the method of cash flow statement. So total cash flow will be segregated into inflow and outflow. Inflow means anything which is receiving to the entity. Inflow, it's called as an inflow. Anything which is going out of an entity, that is called as an outflow. So in simple manner, whenever there is a gain or whenever there is a sale, we have made if entity has made any sale, if entity has made any gain, then that is called as inflow. If entity has purchased anything, goods or services, if entity wants to pay back, then it's called as an outflow. So cash is segregated into two parts, inflow and outflow, and as well as they are further segregated into three sections: operating activities, investing activities, financing activities. So that where this cash has been used, for what purpose this has been used, so that easily it can be understood by each and every readers of the financial statements. And so operating activities means here anything related to the general regular nature of the business transactions, like purchase of goods and services, selling of goods and services, payment of interest, payment of taxes, payment to suppliers, payment to employees, payment to utility service providers, and receipt from the customers or receipt from different sources. So each and everything generally it will comes under operating activities. So investing activities means part section B, anything is related to the not related to the nature of business generally, like purchase and sale of fixed assets, purchase and sale of long-term investments will comes under here. If you sell investments, if you sell fixed assets, you will get money or you will get inflow. That will be presented in a plus positive manner, positive cash flow. If you want to purchase, if you sell any assets or if you sell any investments, you will get an inflow, right? Assets are going, but cash is coming in. So that is called as inflow. So everything we will see from cash. If cash is receiving, cash is going. If cash is coming, it's an inflow. If cash is going, it's an outflow. So if you purchase any land and building or any investments, we need to pay cash generally. So that's an outflow. So that will be in a negative manner. So if you see from financing activities point of view, there will be two types of financing activities. Number one is banks loans related to debts. Number two is purchase or sale of shares or bonds, securities. If you are issuing shares or issuing bonds or if you are taking loan, so you will get a money inside. So that's always inflow. If you want to repay or redeem or buy back, then that is a outflow of cash. That is called as a negative here. So if you go how many methods, so I hope you understood this. So inflow and outflow segregated into three parts: operating, investing, and financing, so that readers can understand for what purpose this cash has been received, for what purpose the cash has been spent. And then how many methods are there? There are two methods: direct method, indirect method. Which method is important? Both methods are important. But corporates will prepare which method? Generally they will prepare indirect method. Is indirect method is very easy? No, indirect method is not so easy. It is very complex and is very difficult when compared to direct method. So even it is complex, why they are following this? As per regulatory compliances. What is this regulatory compliances? Even if it is as per accounting standards, or even if it is as per US GAAP, or even if it is as per IFRS standard accounting standards board, they are saying you can follow either any of the method, no problem. And for MFSC, they are suggesting to go for, if you see IFRS standard board, they are suggesting to go for direct method only. That is easy to understand, easy to prepare. Why? Because in direct method, just what is the cash is received and what is the cash paid. Just we will see the cash pool, how much is received, how much is paid. That's it. So it is easy to prepare, but it doesn't give proper meaning to analyze and understand in terms of working capital, or in terms of inventory, or in terms of receivables, in terms of payables. It doesn't give a proper meaningful analysis compared to two accounting periods, what has been happened between beginning to ending, how it has the cash has been flowed between two accounting periods. Generally it will not give the proper meaning if you prepare under direct method. That's why it will prepare under indirect method. Under indirect method, how they will prepare, we will take net income as per the P&L and we will make certain adjustments, and after making the adjustment we will get cash flows from operating activities. Even if you go direct method, indirect method, the difference is only for operating activities. This section A only. For section B and section B and C, it remains same. Under direct or indirect method, this remains same. The difference is only for section operating activities only. So what you will do here, we'll take net income or profit and loss as a P&L and we'll make certain adjustment. What adjustment you will make? Non-cash items which is available in the income statement, like depreciation, amortization, and as well as non-operating items which is available in the P&L, like a gain or loss on sale of investments, fixed assets, etc. So, and whatever the provisions and accruals we made in the P&L, we will remove all that. So in layman's language, in simple terms, we'll take P&L. From this P&L, the whatever the profit has been shown, we'll take that as a base point and we'll make certain adjustments to that, and after that we will get this cash flow from operating activities section. Why will make an adjustment? Why this is required? This is important question. Why? Because the shareholders or the stakeholders or financial institutions, anyone, they will focus and they will give much more importance and the confidence for cash flow statement rather than the income statement and the balance sheet. Why? Because income statement, which is prepared under accrual basis of accounting, entire financial statements prepared under accrual basis of accounting, but in the income statement there are certain provisions, there are certain accruals. Even income which is shown in the P&L, that is not generally, it is actually cash is received. In a similar way, whatever the expense which has been shown in the P&L doesn't mean that which has been already really paid. Income point of view, it is probability that it will receive. From payable point of view also, it shows it is a probability that the obligation that will pay in the future. But really it is not paid, really it is not received. So why? Because whatever the P&L it is shown in the profit, whatever is shown in the P&L doesn't mean that much of profit. For example, in the P&L, if there is a 1 million profit, net profit, doesn't mean that this much of 1 million is exactly available in the cash balance. Doesn't mean that this much of cash is generated during the accounting period. Doesn't mean that really we generated 1 million profit to match with net profit in the P&L. It doesn't mean. That's why there is a likely possibility that the P&L account can be get manipulated in terms of revenues and expenses. In terms of balance sheet also, it can get manipulated. How they will manipulate? There are 101 ways to manipulate P&L and balance sheet. We will discuss in a short summary going videos. In the previous video also I discussed little about that. So anyone will give much more importance to cash flow statement rather than P&L and balance sheet. But whatever the manipulated P&L balance sheet, the same will be flowing in the cash flow statement also. No? So cash flow statement also will also direct impact based on this P&L balance sheet. So why they are giving much more importance to cash flow statement when they already get manipulated? If got manipulated, then why they still are giving importance? Why? Because cash is a king. In any business, cash is a king. Profit is not a king. Your land and building, plant and machinery investment, that is not a king. Cash is a king. Why? Because if you want to purchase any goods and if you want to purchase any services, the suppliers, they will ask you, please pay this cash. If you say, see, this much of profit I have in my P&L, this much of land and building investments I have in the balance sheet, please consider this and provide me delivery of goods and services. And they will not deliver your goods and services based on your P&L, based on your balance sheet. They will deliver your goods and services based on your cash payment, based on your creditability, based on your cash position only. They will deliver. Even your employees, at the end of the month, they require salaries. If you don't give salary, they will walk away. If you see my P&L, how much profit is there, 1 billion profit is there, see my balance sheet, how much value of investments we have made, no one is going to listen, no one is going to care all this. All these are important and appreciated for some other purpose, but to run the day-to-day operations of the business entity, cash is required. Cash is the most important element, and this is the king in the organization, even not in the corporate life, even in personal life or anywhere also. Cash is important. Without cash, nothing is going to happen. either corporate life cycle or even human life cycle also, the cycle will get end with if there is no cash. Even a business, they might be showing 1 billion profit in P&L, they can show 1 billion in the retained earnings, but if they don't have cash for a particular period, then they cannot survive in the market, and it will go into bankrupt. There are many corporate entities, they are showing that there is a good amount of profit, but they went to bankrupt. Why? It is not just because of profit, it is because of cash. If there is no cash, and if there is a consistent negative cash flows for more than one accounting period, and if it is not corrected within that due time, then there is a likely possibility that the company can go for liquidate and the company go into bankrupt and the company will close. So because of that, cash flows and cash is very very important. Without that, entity cannot survive. Even though there is a positive P&L, even though there is a profit in the P&L, even though there is a good amount of returned earnings, the balance sheet is very strong, but despite of that, if there is a negative cash flows and if there is no cash in the business cannot run and they cannot survive for the long period of time. But however, we need to understand that positive cash flows doesn't mean it is a very good to the entity, and negative cash flows also doesn't mean it is a very bad to the entity. I will explain to you. See, whenever there is a profit in a P&L, doesn't mean that your cash flows is positive, and whenever there is a negative in the P&L, doesn't mean that your cash flow is negative. This can be reverse way, this can be in a opposite way. They can be profit, but cash flows can be negative. They can be loss, but cash flows can be positive. In interversal relationships is possible. So whenever there is a positive cash flow, doesn't mean that you are doing very well, but because the positive cash flows can be due to some other purposes, can be due to like you sold your building, you sold your investments, you sold your fixed assets, and you sold all your valuable assets, and you want to take that cash. And why you sold? You sold to repay your suppliers and to pay to the salaries employees. So that there you generated cash. So in your cash flow statement, it is showing positive. But is that positive is a good to the entity? Selling of fixed assets, selling of investments, and whatever the amount you received, that amount is utilized to pay taxes, pay interest, and pay to the employees or salaries. Is that good to the entity? Certainly not. So even though there is a positive cash flows, doesn't mean it is a good. In a similar way, if a company is going for investments, and if a company is going for repayment of loans and repayment of buyback of shares, they will pay. Whenever they are paying, it's a negative in terms of investing section as well as financing section. So since it is negative, doesn't mean it is a bad, right? The company is going to expand, since if they are purchasing fixed assets, making investments, they are expanding for the future. And when they are paying back to the loans, paying back to the shareholders, means they are reducing their interest portion, finance cost, and reducing the dividends cost in the future. So that's a good sign. So positive cash flow doesn't mean it's a negative. So negative cash flow doesn't mean it is a positive cash flow, doesn't mean it's a good to the entity. In a similar way, negative cash flow doesn't mean it's a bad to the entity. We need to see why it is positive, why it is negative, for what purpose this positive is going to use, and for what purpose this negative is going to use. What is the intention, what is the purpose, what is the ideology behind this, and what will happen in the next accounting period or next quarter, next month, based on this positive negatives. What is the intention of this management, for what purpose this has been positive negative. This is what we need to analyze on case to case basis. Thereafter we can come to a conclusion whether positive is a good or positive is a or negative is a bad. We can come to a conclusion. But generally, wherever there is a negative, generally it is not recommended. For one quarter, this is fine, it is acceptable. But if it go beyond 2 quarters and 3 quarters, and if you go beyond one accounting period, negative cash flows is a very danger to entity, and it can go for bankrupt also. So we need to be very careful with the negative cash flows. Hope you understood the crux of the subject, and if you like the subject and this video, please like and share and subscribe the channel and share it in the network, and I will be posting series of videos very shortly. Thank you very much.